Everyday Australian business owners ask me if the dream of building real wealth is dead. You might think the only answer is work harder, take on more clients, grind for another 5 years. But the truth is, the old rules of working hard and saving cash no longer apply. If you want to build real wealth today, you have to play a completely different game. With over 35 years in business advisory, I've helped thousands of Australian business owners save hundreds of millions in tax, structure for wealth, and build a large portfolio of assets outside of their business. So in this video, I'm going to break down exactly how you can still build serious wealth in Australia and the 3 strategic shifts you need to make right now to do it. Number 1 factor is superannuation is not a complete wealth strategy. Most business owners treat super as a set and forget safety net. Superannuation is important, but it should not be the only entire retirement plan. Wealth creation means taking active control of assets, not hoping the default path is enough. Business owners often focus on revenue, tax, wages, and cash flow, while super is ignored for years. Inflation and lifestyle expectations can make a standard super balance feel inadequate. SMSFs may suit some owners who want control over direct shares or commercial property, but they are not automatically the best options. The real question is, does the owner have a complete wealth plan across super, business value, and assets outside of the business? SMSFs can invest in commercial property, but strict rules apply, especially for related party transactions. SMSF may acquire a lease business real property to a related party if the property qualifies as business real property, the transaction is at market value, rent is at a market rate, lease terms are commercial and at arm's length. An SMSF borrows to buy a property, it must generally use a compliant limited recourse borrowing arrangement or have the cash to do it inside of the super fund. SMSFs involve costs, administration, annual audits, trustee obligations, liquidity risk, and concentration risk. Just using an example, a business client was worried super would not be enough for their retirement. With advice, they transitioned into an SMSF. The SMSF bought their commercial premises. The business paid commercial rent to the SMSF for a number of years. A major business expense became part of their retirement asset base. This is not a blanket SMSF recommendation for every business owner. It only works where the fund balance, the property, the lease, the borrowing and the cash flow, and the compliance and risk profile all stack up. The practical application of this is to look at your exact super balance, project it forward 10 years using conservative assumptions, and if the number does not support the lifestyle you want, get advice on whether an SMSF direct investment or investments outside of super are appropriate. In looking for superannuation advice, ensure that you get a licensed professional to give you that advice. Number 2, business profit versus personal wealth. A profitable business does not automatically make the owner wealthy. If every dollar stays in stock, equipment, working capital, or the company bank account, the owner may have income but not personal wealth. I see this very often with my clients on a daily basis and give them the advice that profit kept in stock and other things can inhibit their ability to grow wealth if the stock is not at an appropriate level. Business owners need to take chips off the table. And that means to pay themselves first and recognise that creating real wealth is not just done within the business. Many owners run strong businesses but have little outside of the operating entity. This comes with risk. Wealth should eventually be converted into assets, less dependent on owners' daily workload. Professional services and construction owners often make strong margins but leave too much wealth exposed to risk inside the business. The operating business should not hold all of the owner's wealth because it carries significant risk, trade risk, staff risk, client risk, risk of litigation, and market risk. Profit and cash flow are different. Many business owners do not recognise the difference. A business can be profitable, but cash flow poor due to debtors, stock, tax, equipment, or working capital needs sucking the cash from the business. Extracting profits can trigger tax issues, including dividends, trust distributions, Division 7A issues, franking credits, and personal tax. Companies and trusts can help with structuring, but they do not automatically solve tax and asset protection issues. Professional services and construction business owners making strong profits, but leaving everything inside the business when the market shifts, a health issue occurs, or cash flow tightens, they realise their personal wealth is trapped in the business. A key qualification to mention is that we don't expect owners to create a fixed percentage of their net profit each quarter to come outside of the business entity as a universal rule. A better way to do this is to create a systematic extraction policy based on the free cash flow of the business, considering tax, considering working capital, considering the debt requirements of every business, the investment goals of the business if it's going to acquire something or need extra cash flow, and considering asset protection. The practical view is to review how much your total net worth is inside of the operating business, decide what surplus profits can be safely extracted and invested outside of the business structure, with tax and legal advice and financial advice, of course. Number 3, structure your business for an exit from day one. So many business owners are in business and have no idea what their exit strategies might be. This could be either a sale of their business, could be the next generation of child coming through the family wanting to continue in the business, or it could be a sale to a third party. We need to consider what the exit strategy is at the point while we are in the business, not at a point when we want to exit. Most owners are trapped in the daily operations of the business and never ask themselves, what is my business worth? Even if they never have a plan to sell the business, they need to build the business so it could be sold, transferred, or managed without them to give them that freedom. The more the business depends on you, the weaker it is as a wealth asset. The valuation capitalisation rate of a business is tied directly to the owner's identity versus the goodwill of a business. Owner dependence can reduce transferability, buyer confidence, and business value. Buyers want transferable profit, clean records, systems, contracts, staff capability, and reduced founder reliance. In that, they will get a higher cap rate for their business on sale. So you need to build managed capability, documented systems, repeatable processes, clean financial statements, and succession options. These are verified facts. Every time we deal with business owners selling, the prices are higher. The Australian government guidance recommends succession planning, business valuations, documented processes, and preparing records for handover on sale. Small business CGT concessions can significantly reduce or eliminate CGT if eligibility requirements are met. Eligibility can involve active asset rules, small business entity status, aggregated turnover, maximum net asset value, and other important conditions. Just as an example, a manufacturing client built a strong business over 20 years. The owner was the sales manager, operations manager, chief problem solver, and wore so many hats. Buyers saw too much reliance on that particular owner, and the exit options were poor. Contrast a client who spent years replacing themselves with a general manager, documented systems, built management capability, reduced owner dependence. They sold for a very strong multiple. Capital gains tax outcomes were heavily reduced because the structure was correct and the CGT concessions were planned properly with early discussions with ourselves. Obviously, we don't try to suggest the business can operate without an owner. If we do that, the business won't meet its goals and a ship doesn't head in the right direction without a captain. What we're trying to say is framing the business to be heavily reliant on the owner can reduce transferability, can reduce buyer's appeal and the potential value of the business. It's a double-edged sword, but we need to meet the fine line that is between. I qualify my point by saying that a business cannot run without an owner. That is not what I'm trying to suggest here. What I am saying though is a business with too much heavy reliance on the owner, that dependence can create reduced transferability of the business. The correct way to structure the business is without heavy reliance on the owner. If we can reduce that reliance, the transferability, the buyer appeal, and the potential value of the business increases significantly. The sale of any business does not automatically receive a zero tax on exit. We need to ensure that we frame the business, plan for the small business capital gains tax concessions. If we do this correctly, we can significantly reduce the cost of tax in the exit of a business sale. All of the eligibility requirements need to be met. Don't automatically happen. These happen through important conversations with myself and my team to ensure the business is set up correctly prior to sale. The practical application of this is to identify all of the tasks that you need to do day in, day out as an owner to ensure that a manager or staff member can run this business without you being there. For instance, if you're having 8 to 10 weeks holiday a year as an owner and someone is looking to buy that business, they can see that they can have a reasonable lifestyle while buying your business for a reasonably high multiple. That is what we need to achieve in a business sale, that the reliance of the business owner is not key to the business. The key message that I mention here is that we can still build wealth in Australia, regardless of current government policy in the 2026 budget. It is still possible, but owners need to be deliberate in what they do within their business. They need to work with accountants such as myself who are adept at giving them the correct advice, making sure that waiting until retirement is not the answer. Waiting for burnout or a forced sale leaves you with few options, increases the risk, and increases anxiety during a sale transaction. You need to plan and plan early and consider things like the net worth of the business value, your superannuation, your property investments, share investments, crypto investments, cash, and other types of investments, your levels of debt, and review these assets on an annual, biannual, monthly basis. What is your current balance of super? What is your projected super balance in 10 years? What is your expected retirement income? If you want $150,000 to $200,000 a year, will your super balance and current investments give you that income? Whether your self-managed super or outside of super is investing needs updating and exploring. Review your wealth concentration. Is too much of your wealth trapped in your business? What assets exist outside of the business? And obviously, what can you do about that? What is your profit and free cash flow? And what can you better do with that free cash flow? What is your tax burden? What's the working capital requirements within your business? I see so many business owners with too much cash sitting in a bank account doing nothing inside of their company or trust. What is your debt structure currently, and what is your investment structure currently? Can the business reduce its dependence on you? I'm sure you might like to see that happen and have a few more holidays where team can show that they can step up. Why don't you start to delegate more? One task a day, document one process a day, develop one manager or one person in your team that can take some of your duties from you. Prepare the business now for an eventual transfer or sale. Business wealth in Australia is still possible today, even with the changes mooted by the Australian government currently that are going through royal assent as we speak. But business owners need to change the way they deal with their businesses and their wealth today. 3 strategic shifts. Super is not a complete wealth strategy. Business profit is not the same as personal wealth. Structure your business for an exit from day one. My closing message to you is the goal is not just to run a profitable business. The goal is to build assets, build wealth, build options, and build freedom outside of the daily grind of your business. Business owners need to be active, planning across super, personal wealth, and their business structure, and be ready for exit. If you're an ambitious Australian business owner and want a strategic accountant in your corner, book a strategy session with myself and my team at manageright.com.au. Thanks for listening.